Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 trending stocks, so let's get into it. Alright guys, welcome back and thank you all so much for being here. Today we're taking a look at 3 stocks that just recently reported their quarterly earnings and are now trending with a lot of new ratings from Wall Street analysts pouring in. So today we're going to take a look at the results of those latest earnings reports, how the stock has been reacting, and what analysts are predicting for the stock's future. If you haven't already done so, make sure you download the TipRanks mobile app by following the links in the description down below so you can access your favorite research tools on the go. Now, of course, we found today's stocks using the TipRanks Trending Stocks page. We can find that by heading to Research Tools and then down to Trending Stocks. We're going to be looking at the most rated within the last 72 hours, and we'll find our list here. Now, we're going to start off with PayPal, as their stock has been moving the most this morning, currently trading down nearly 12%. The PayPal stock trades under the ticker PYPL, currently priced at over $66 per share. That is down from a 52-week high of over $103. And we can see this drop off here this morning following their latest earnings. What's interesting is that PayPal actually came out with a beat on both earnings and revenue. They reported Q1 earnings per share of $1.17, beating expectations by 7 cents per share, and they reported revenue of $7.04 billion, which grew over 8% year over year and came in $50 million ahead of estimates. PayPal attributed these results to their cost-cutting initiatives and even increased their full-year guidance. So why is the stock declining? Well, it seems investors are focused on their operating margin guidance, which the company reduced to at least 100 basis points from their previous expectations of about 125. Adding downward pressure to the PayPal stock are some of these upgraded analyst ratings, including one who actually downgraded their rating from a buy to a hold. That downgrade came from Timothy Chiodo of Credit Suisse, who changed their buy rating with a $100 price target to a hold with an $85 price target. They pointed out unfavorable catalysts including transaction margin pressures, an uncertain macroeconomic environment, higher competition, and management's pending transition. We also have an analyst from Susquehanna with a hold rating who lowered their price target. Analyst James Friedman said, "We are still wait and see as we trim 2024 margins and earnings per share as we play the dilutive growth forward." As the stock continues to drop, they're getting close to lows that they haven't seen since 2017. But even with some of those downgraded price targets, the stock still comes in overall as a moderate buy. The average price target comes in at $115 per share, which would be an upside of 73%. And you can see our average and low price targets are fairly close here, with one very high-end price target over $350. Looking at our ratings from day, we do have our holds, and despite some lowered price targets, still some very favorable upsides, ranging from 17% all the way to upsides of 140%. Today's second trending stock is Skyworks Solutions. Their stock trades under the ticker SWKS, currently priced at about $100 per share, and you can see that drop off this morning, currently down over 4%. For their quarter, they did report earnings in line with expectations, but the chipmaker did report a second quarter straight of declining revenue. For their second quarter, they reported earnings per share of $2.02. On the revenue side, they reported $1.15 billion, which did decline 14% year over year. On top of this, Skyworks also issued some disappointing future guidance, citing difficult conditions in the chip industry. For their third quarter, they said that they're anticipating revenue in the range of $1.05 billion to $1.09 billion and earnings per share of $1.67 at the midpoint. This was well below the analyst expectations of $2.06 earnings on revenue of $1.15 billion. And once again, we do have some analysts downgrading their ratings. One analyst said it was not so much that Skyworks guided down June revenue versus expectations. We can live with lower top line in a choppy market. It's the multi-quarter headwind to their gross margins that we're uncomfortable with, combined with the very high inventory that the company has on its balance sheet, which will likely impact the latter over several quarters. We have had 10 analysts update their price targets just today, and 8 of those do still come in as a buy, though we have seen many lower their price targets a bit. The average price target comes in at $118 per share, which would be an upside of 18% for this next year. Taking a look here, I think we're missing a digit on this one because it does seem like a drastic buy rating with a big downside, so we don't think that's accurate, but we do have our hold ratings with an upside of 4% and many others ranging from 14 up to 48% growth potential. And our third stock that is trending following their earnings is tech company Western Digital. Their stock trades under the ticker WDC, currently priced at about $33.50, down from a 52-week high of about $63. Now, their stock did take a drop off this morning and was down about 6% at one point, but has climbed back a bit, now down only 2%. Although their revenue did decline year over year, Western Digital came out with a beat on both earnings and revenue. They reported a loss per share of $1.37, which was 20 cents better than analysts expected, and revenue of $2.8 billion did decline 36% year over year, but came in $110 million ahead of estimates. But their guidance for their fourth quarter revenue did come in below expectations, with a range of $2.4 to $2.6 billion versus the $2.83 billion anticipated. Now, there is a big mix of hold and buy ratings coming in following this earnings report, but one analyst does think that Western Digital's market may be reaching a bottom. Wedbush analyst Matt Bryson wrote that the broader NAND market appears to be finally approaching a bottom, helped by a combination of production and capex cuts and the expected improvement of shipments into client consumer markets, as we believe destocking is slowing as customer channel inventories have largely normalized with both content growth and some modest improvements in demand that is likely to lead to a better second half of 2023 fundamentals. Wedbush does rate the stock a buy with an average upside of over 79%. They are one of 13 analysts with a current rating. Overall, the stock comes in as a moderate buy with 6 buys, 6 holds, and 1 sell, and an average upside of nearly 23%. And we can see that mix of buys and holds all coming in today. Now, we do have a low end that has a downside of over 13%, and then several ratings in between going up to that Wedbush high at 79%. So there we have 3 stocks that are trending with new Wall Street ratings today. Now, it does seem that there is some tempered outlook for these as a lot of people are lowering price targets, but still some pretty bullish outlook overall. Let me know your thoughts in the comments of these 3 stocks and if they have the growth potential that these analysts are predicting for the next year. Always keep in mind that these videos are never a suggestion to buy or sell any specific stock, just to keep you up to date with what's happening with those Wall Street analysts and to provide some information and entertainment. Please make sure you're always doing your own research and due diligence before making any investment decision. If you made it to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thanks so much for watching. Have a great day, and I'll see you back here next time.